Hundreds of thousands of dollars simply vanish. Having children drastically alters your taxes and your financial future. This massive shift begins immediately upon a child's birth or adoption. Many parents do not fully grasp enormous financial implications. Your tax filing status changes, for one thing. If you are single and have a qualifying child, you can file as head of household. This gives you a larger standard deduction than filing as single. It also often means you are in a lower tax bracket for your income. The standard deduction for head of household can be around $20,800 for 2024. This is a big jump from the single filer deduction of about $14,600. This one change alone saves families hundreds of dollars. It represents a significant financial advantage many parents overlook. The child tax credit is another huge benefit. For each qualifying child, this credit is up to $2,000. A child must be under the age of 17 at the end of the tax year. They must also be claimed as a dependent. Up to $1,600 of this credit can be refundable. This means even if you owe no tax, you might still receive a check for that amount. Imagine getting a check for $3,200 if you have two children. That money can cover many costs. Things like diapers and formula add up fast. A baby might use 2,700 diapers in their first year. Formula can cost over $1,200 annually. So that tax credit is extremely helpful. It eases daily financial pressures. Then there is the credit for other dependents. This credit is $500. It applies to children aged 17 or older. It also applies to other qualifying relatives. This ensures some tax relief even for older children. It helps families with multiple children of different ages. Suppose you have one child aged 15 and another aged 18. You could get $2,000 for the younger child and $500 for the older child. That is $2,500. That is a significant amount for any family budget. This credit ensures some support. Even after a child ages out of the main child tax credit, the child independent care credit helps with child care expenses. This credit covers a percentage of costs. These are costs for daycare, summer camps, or after-school programs. To qualify, both parents must work or be looking for work. The credit can be up to 35% of your expenses. For one qualifying child, you can include up to $3,000 in expenses. For two or more children, you can include up to $6,000 in expenses. This means a maximum credit of $1,050 for one child. For two or more children, it is $2,100. Childcare costs are a massive expense for working parents. Many families spend $10,000 or more per child each year on childcare. This credit makes a real difference. It helps families balance work and family. The Earned Income Tax Credit, or EITC, is another major benefit. This credit is for low to moderate income working individuals and families. The amount depends on your income and the number of qualifying children. For a family with 3 or more children, it can be over $7,800. For 2 children, it can be over $6,900. For one child, it can be over $3,900. This credit is also refundable. Many families rely on the EITC to make ends meet. It is designed to lift families out of poverty. It encourages work. This credit helps cover essential living costs like rent and food. It provides a safety net for millions of working families. Adoption expenses can be very high. The adoption credit offers substantial relief. For 2024, this credit is up to $16,800.10 per child. This credit is non-refundable. It can be carried forward for 5 years if you cannot use it all in 1 year. Imagine paying $20,000 or $30,000 for an adoption. This credit helps offset a huge portion of that cost. It makes adoption a more financially feasible option for many hopeful parents. It removes a significant barrier for families wanting to grow through adoption. Adoption costs are complex and high. Education expenses come later, but start early. Some parents save through 529 plans. These plans allow money to grow tax-free. Withdrawals are also tax-free if used for qualified education expenses. This includes K-12 private school tuition. Up to $10,000 per student per year. This is a huge benefit for families choosing private education. For college, there are more credits. The American Opportunity Tax Credit is up to $2,500 for the first 4 years of higher education. The Lifetime Learning Credit is up to $2,000 for undergraduate and graduate courses. These credits can save thousands of dollars over a child's educational journey. Planning early for education costs eases future financial pressure. There are also tax-advantaged accounts. Flexible spending accounts, or FSAs, for dependent care let you set aside pre-tax money. You can use this for childcare expenses. The maximum contribution is $3,200.50 for 2024. Health savings accounts, or HSAs, also offer tax benefits. You can contribute pre-tax money It grows tax-free. Withdrawals for qualified medical expenses are tax-free. These accounts can be used for your children's medical needs. They reduce your taxable income. They provide significant savings over many years. A typical family might spend over $4,000 annually on healthcare costs for children. These accounts help manage that. Using these accounts lowers your adjusted gross income and tax bill. The kiddie tax is something to watch for. If a child has unearned income above certain thresholds, it is taxed at the parent's rate. For 2024, the threshold is $1,300. Above this amount, the income is subject to the kiddie tax. This prevents parents from shifting investments to children to avoid higher taxes. It applies to income from stocks, bonds, and other investments. It is important for families with significant assets to understand this rule. It ensures fairness in the tax system. This rule applies to children under 18. Beyond federal taxes, many states offer their own child-related tax benefits. Some states have their own child tax credits. Others offer deductions for dependents or childcare expenses. For example, a state might offer a credit for $1,500 per child. These state-level benefits can add up to hundreds or even thousands of dollars more in savings. It is vital to check your specific state's tax laws. Each state has unique rules and programs. This adds another layer of complexity to family tax planning. Local research is always a good idea. The cost of raising a child to age 18 is staggering. Estimates often exceed $300,000, not including college. This figure includes housing, food, transportation, healthcare, and education. Every single tax benefit helps offset these monumental costs. The average cost of food for a child can be over $100 per week. Clothing can be several $100s per year. Sports and activities add another $1,000 or $2,000 annually. The financial burden is immense. Parents must budget carefully, leveraging every tax advantage. Many parents forget about Social Security benefits. Having children can impact your future Social Security. If one parent stops working or works less to care for children, their lifetime earnings might be lower. This could reduce their future Social Security benefits. However, children can also receive benefits if a parent dies, becomes disabled, or retires. For example, a child can receive up to 50% of a parent's full retirement or disability benefit. This provides a safety net for families. It is an important but often overlooked aspect of having children. This is part of comprehensive financial planning. The paperwork and complexity also increase. Filing taxes with children involves more forms and more calculations. This is why many families seek professional tax help. The average tax preparer might charge $300 or more. Understanding all the rules and changes takes time. Keeping meticulous records of childcare expenses, medical bills, and adoption costs is crucial. You need birth certificates and Social Security numbers for all dependents. Missing a single detail could mean missing out on thousands of dollars in credits. An organized system saves immense stress. Families also need to consider estate planning. With children, you need a will. You need to name guardians. You need to plan for their financial future. This involves more legal fees. An attorney might charge $500 or $1,000 for a basic estate plan. While not strictly a tax change, it is a direct consequence of having children that impacts finances. And some estate planning strategies have tax implications down the road for beneficiaries. This is another layer of complexity. Estate planning provides peace of mind. Tax laws change constantly. What applied last year might not apply this year. For example, the child tax credit amount has varied in recent years. In 2021, it was $3,600 for children under 6 and $3,000 for older children. It was also fully refundable. This temporary expansion provided huge relief. Staying informed is a continuous challenge for parents. Tax updates happen yearly. New legislation can completely redefine benefits. This means annual research and diligence are required. It is not a set it and forget it situation. Professional help can keep parents informed. And what about unexpected events? Losing a job changes everything. Your tax benefits might change drastically. A sudden medical emergency for a child can create huge deductions. Medical expenses exceeding 7.5% of your adjusted gross income can be deducted. This can amount to thousands of dollars in deductions if a child has significant health issues. These situations are difficult, but the tax code offers some relief. It is important to know these provisions exist. An emergency fund is critical for unforeseen costs. The sheer volume of financial decisions increases with children. Buying a larger home to accommodate a growing family means higher property taxes. Property taxes can be thousands of dollars annually. Moving to a school district with better schools often means higher property values and thus higher property taxes. These are indirect tax implications, but very real. A family with 2 children needs more space. This often means a mortgage payment of $2,000 or $3,000 per month. This directly impacts disposable income. These choices have ripple effects on finances. Consider the time commitment involved in managing these financial changes. It is not just about the money, it is also about the hours spent understanding tax code. Hours spent gathering documents, hours spent planning for college savings. A parent might spend 50 hours a year just on these financial tasks. This time has an opportunity cost. It is time not spent with family or on career development. This is a hidden cost of having children that taxes highlight. Deciding on professional help is a personal calculation. Many parents discover these complex changes only after their first child arrives. They are often caught off guard. The initial joy of parenthood comes with a steep learning curve for finances. It is a crash course in tax law, family budgeting, and future planning. This is why early education on these topics is crucial. Financial literacy is key. Knowing what to expect allows for better preparation. Better preparation means less stress and more savings. It is a powerful advantage to understand these shifts from the outset. Proactive learning brings monetary gains. The tax code is intricate. Each dependent adds layers of intricacy, from birth certificates to social security numbers to childcare provider tax IDs. Every piece of information matters. A single-digit error on a tax form can delay refunds or trigger audits. This is not just theoretical. It happens to thousands of families every year. Accuracy and attention to detail are paramount. Tax software helps, but understanding the underlying rules is still essential. It is a system built on precision. Even a small mistake can lead to issues and extra effort. And the long term, these tax changes do not stop when a child turns 18. Education credits continue, estate planning needs evolve, grandchildren might bring new considerations decades later. The financial ripple effect of having children extends across generations. It is a lifelong journey of financial adjustments. The impact is truly profound and continuous. It requires ongoing attention and adaptation. This journey underscores lasting financial responsibility.